Hello. Hello, members.
Hello, sir.
How is the evening like? It's an afternoon here.
Yeah. Hello, sir.
How are you doing?
Yeah, all fine, sir.
All right. I really want us to spend a few minutes to look at what I personally consider as important, and then from here we'll be able to carry on with other sessions to build upon what we start today. So I want to welcome you to this webinar session organized by Binary Winners Club. Your speaker is Bernard, and I think you know me from the group itself. So feel welcome, and let's get to engage on this particular session. As I had indicated on the platform, my discussion today will be on the application of TLS. You may have wondered what TLS means, but in essence, when I'm talking about TLS, I will be talking about these three important things in trading. This is what I consider three important things, most important things that you must have for a valid trade. Okay, three. There are many, but I think when you have these three, you will feel much more confident to enter setup. This item number one is the trend. Item number one is the trend, and I will explain each of them. Item number two is a support and resistance zone. And item number three, when I say support and resistance, this is where I'm talking about a level. This is the level itself. And item number number three is a candlestick signal. A candlestick signal. Okay. You can call it a pattern, but this is what I'm calling a signal. Okay. So again, for those who've just come in, we're talking about these concepts here now. We are talking about these concepts, what I'm calling TLS from the group, from what I shared, application of TLS. So TLS here stands for trend. T stands for trend. Okay. T stands for the trend. L stands for the level. Yeah. And S stands for signal. Are you following, guys?
Yes, sir.
Yes, I'm saying there are three things you must at least ensure you have before you enter trade. Number one, I was saying you must have a trend in place. That is T. Number two, you must have a level. Your level here is support and resistance. And number three, you must have a signal. S. Your S here is a signal. And our signal would be something from a candlestick itself. So this could be an uptrend or a downtrend. So for every setup you want to take, if you are really a very keen trader, you will ensure you observe at least these three. There could be four more factors like volume, there could be divergence, there could be others, even 4 or 5 more. But these three are the minimum you should have for every setup, these three. And I thought apart from mentioning these three things, I would like us to learn how you need to apply this on a chart, so that we don't just say follow trend. People don't know how to define a trend. We don't say pick your trade at a level. People don't know what the levels are. We don't say pick a signal from a candlestick. Some people don't know what these signals look like. So do you feel like this is something worth discussing going forward? Hello?
Yes, sir. Listening.
Yeah, do you feel this is important to discuss so that, or is something you people already have knowledge of and we don't need to discuss about it?
Yeah.
Okay, then, if you agree, then we will proceed from there. So, number one, we are saying we need to follow the trend. Now, very quickly, I will mention what the trend is. I will mention what the level is. I'll mention what a signal looks like. In future videos, in future webinars, we'll have another webinar next week. We will spend more time discussing more about these things. But for now, I want to give you an illustration of what it is to use the three concepts. Already we know from basic concepts that a market moves up and comes down a little bit. Market moves up again and comes down. Market moves up and comes down. Now, when you see a market doing this kind of a behavior, these are the things. These are the things we call. Hello. Okay, I think I may have to mute some of us. Please mute yourself that way. Then you can unmute yourself when you want to talk. So I was indicating that we need to know these things in the market so that we don't end up trading wrong setups unnecessarily. So when you see this, these are swings. We might call them swings. All right. So the top ones, this, if I were to use a different color, that is a swing high, a swing high, a swing high. In price action world, or when you are studying price action, the words you would hear people use here, this would be a high, followed by a higher high, followed by another higher high, okay? And this would be called a low, followed by a higher low, followed by a higher low, followed by a higher low. Now, when you see market doing this kind of movement, moving like this, then you know this is an uptrend. Correspondingly, if you see the market doing this, that's a downtrend. In other words, there is a high here, followed by a lower high, followed by a lower high, another lower high. Meanwhile, on the other side, we have a low, followed by a lower low, a lower low, a lower low in that order. Now, that's a signal that you have a downtrend. Now, generally, that's how we should interpret a trend if you were to use price action. Now, unfortunately, not all people are comfortable with assessing market direction using higher highs and higher lows concept. Some people have a problem identifying that. For example, when I'm on this chart, it will be okay for me to identify these swings as this could be a swing high, a general swing high, another one down like this. I may be comfortable doing this, but not everybody may be comfortable doing this. So I can see a high here, a low, a high, a low, a high, a low, a high, a low. So I need to be familiar with this. But again, you might also want to use major swings like this. This is a swing, that's another swing, that's another swing. So if you use this approach, this is a complete uptrend because this is a high, a higher high, a higher high. This is a low, a higher low, and another higher low. You may have ignored this or skipped this. Now, for those who have a problem using the higher high, higher low concept and lower high, low, lower low concepts, you can apply some indicators that would help you start seeing the trend without struggling much. One popular indicator I prefer using is the 20 moving average, 20 exponential moving average. When I throw this indicator on the chart, I would see this, okay? I would see this. Now, ordinarily, people would argue or say when the candles or price is above the line, it's an uptrend. That's not a problem. When price is below the line, that's still a downtrend. That's fine. But I also like adding a second line, 50 EMA. And when I do that, now I have a better vision of a trend. So when these lines cross, and until they cross back again, I will assume that's an uptrend. When they cross here, I hope you can see my cursor. And market is moving down. As long as the green one is below the red, I will assume that's a downtrend. Still, I insist, even when you are doing that, remember to check the lows and the highs, because moving averages are lagging indicators. And because they are lagging indicators, chances are the trend will change direction before the moving averages cross over. Okay? So at any one point in time, if you feel you have a question you want to ask, please unmute yourself and ask me a question. So are we okay with how we look at trend? Later on, I'll talk more about trend, but for now, consider using the concept of higher highs and higher lows for an uptrend. Consider using the concept of lower highs and lower lows for a downtrend. Is that okay, guys?
Yes, sir.
Yeah.
Okay.
Yeah. Okay, sir.
All right. So it depends. If you have mastered price action, you can use this. This is how Dow, Charles Dow explains trend. This is from Dow's theory of market trends. But you can use moving averages also to tell you the trend of the market. And of course, I've said if you can mix the two, it's much better, because the moving averages will visually and quickly tell you the trend. But when the lines start changing direction, you will use the higher highs and higher lows concept to tell you that the market is not in an uptrend. So that covers item number one, which is T, trend. Now, item number two is, as we said from the beginning, after you've covered the trend, the second component you must have on a chart will be level. Now you know the trend. A trend can be up, like here. A trend can be down, like on this other side. Now, after covering level, we need to talk about, after covering trend, we need to talk about level. Now, level here is support and resistance. Support and resistance. Now, remember, support and resistance could be static support and resistance, like the horizontal ones we draw. All right. It could be dynamic. Dynamic support and resistance is one that moves with the price, such as moving averages, Bollinger Bands. Those are, support and resistance levels that keep moving with the price. The static ones are the horizontal ones, and the diagonal ones, which we call trend lines. So trend lines are diagonal support and resistance. The ordinary horizontal levels are also support and resistance. So we need to be familiar with both of them. So let's look at how you start trading now, a better way than just gambling. So you will have a rule, and your rule will be saying something like this. You will say this: in an uptrend, you only do higher options or call options. In a downtrend, you'll only do lower, or you will do put options. Okay? So that's now when you combine the two items. If you go to IQ option, that is the language they use. Initially, they used to say this was put, this was call. I think about 2 years ago. Now they labeled this higher, lower. Initially, it was put and call. That's how we were using the concept call and put previously. So even when you are on IQ option, if you have added your moving averages, for example, your policy should be simple. In an uptrend, when green, which is 20 EMA, is above 50, which is 50 EMA, that's 50 EMA, when they are arranged like this, it means the short-term trend is up, the long-term trend or the medium-term trend is up. Remember, 20 EMA analyzes 20 previous candles, 50 EMA analyzes 50 previous candles. So this is your short-term uptrend, this is your medium-term uptrend. You can add 100 if you want, or 200 EMA. I just need the two. And the logic is very simple. Like I said from the other explanation, if the shorter EMA or faster EMA is above the longer or slower EMA, you have an uptrend. So when you have an uptrend, you consider doing higher options or call options. Question: where do you need to do these higher options or call options? One popular way of trading in trends like this is to do this. in an uptrend, and it's important to get note of this. In an uptrend, if you are in an uptrend, you trade at support. In an uptrend, you trade at support. You don't trade at resistance. You trade at support always. In a downtrend, you trade at resistance. Please confirm that point is correct, because that's how we will proceed from here. Whenever you have an uptrend, confirmed either with your moving averages or your price action concepts, you take your trades at support. If you have a downtrend, you take your trades at resistance. Now, if you do that, you will have obeyed rule number 1, trend. You will have obeyed rule number 2, level, which is support and resistance. Now, I want to demonstrate how you could start taking setups like this. For example, you are here now, and you are sure the market is moving up because the lines are telling you there's an uptrend, okay? Now, with the uptrend in place, you start drawing your levels. How do you draw the levels? You look for where market has changed direction. Candles were moving up, they change direction, they start moving down. You place a line there at the body and at the wick, like that. You create a zone. Now, whenever this line is broken, if your resistance is broken and the price ever comes back to that level, you can potentially use that level as support. So market has not come back to that level. It went up and created a new resistance here. Can pick that together with the wick, a tiny wick there. Later on, it gave us those wicks, so I can assume that is my resistance. Down here, you can see there was a support body. Market reversed from here and went up. So body to wicks, I draw that. Okay. So what is my expectation? If market goes above this level and comes back to this level and gives me a signal, then I will pick a trade. I'm trading at support only. So this is my support area. And if a candle closes at in this area and I have a signal, a candlestick pattern or a rejection, I can be able to pick a setup. We talk about setups after that. So market continues going up and gives me a resistance. I draw that zone and the wick or the shadow. I combine the two. Market breaks above. We are still in an uptrend. I wait for market to come back to the same level. Then I look for a signal at support. So in short, what I'm saying is this. What I'm saying is this. If you have an uptrend, okay, you wait for a signal. You pick a signal at support. If you are in a downtrend, you pick your signals at resistance. Now you might be asking, support and resistance. Also remember, a broken support is resistance. This resistance was broken, is support. If this line is broken, which is now support, broken coming down, it acts as resistance here. So if I were to trade this chart, then how would I go on to trade it? If I were to trade this chart, for example, we started from this left side, we broke above the zone, we came back below, okay, to this level. If you are a very conservative trader, you would wait for a candle to close exactly at the level. Doesn't always happen. This is a red candle closing exactly at a level. Then this can become your entry. This can become your call for 1 minute, for 3 minutes, for 5 minutes. Remember, you are trading at support and the trend is up. So you have an advantage. So that trade proceeds, and that is a winning trade for now. Market creates resistance. Market creates resistance, which is broken here. This resistance is broken. Market comes to the same level, but there's a gap. Closes very close to the level, but there's a gap. If you are a conservative trader, you would wait for the candle to come and touch your level before you enter call. Expiry would be the same candle in a case like this. Why? The distance between this line and this line is so close. You don't expect many candles to carry on upwards. Then this level is broken. You expect this resistance that was broken to act as support later if market comes back to the same level. So market comes back to the same level, all right? Gives you a pin back kind of candle. that could be a doji of some style, comes back to the level, doesn't even touch, so you don't enter trade because it didn't close at the level the way you wanted, for example. There are many strategies for support. So for now, I'm only picking on those that you could say are clear, that a candle has closed at the exact level. So what you notice then is the market, let me clear this to avoid confusion. The market breaks below what was initially support. You can include the wicks. This was support, market closes below. That's a breakout, comes back to the zone. This candle closes right on the zone, this one, red one here, or even this one. You could consider this is the upper level of the zone. Remember, the zone is that line and this line. So this candle closes at the topmost part of the zone. So if it closes below here, you can put. If it closes on the other line, you can still do a lower option, which is what would have given you a score there. Now, if you follow that market again, you would see later after that, that the market gave you a new level. This level was broken later on. The entire level, this to this, market broke below it, got back. You see those gaps? I don't like those gaps. We close. Again, there was a gap. What kind of gap is this? Let me draw this line precisely to avoid tricking the markets here. This line closes, there's a space, goes up, comes back down. It doesn't seem to give me the exact entry I'm looking for now. Remember, we are not even talking about strategies. We are talking about how to use the TLS approach. Market gives you a support level, breaks below the level, goes back, closes below the level, okay, goes back. Look at where this candle closed, right on the spot of your broken support, which is resistance. And as it closed at that point, it gave you a winning signal there. So that's one way you could use to trade. It's one approach you could use to trade. Now, what you see me doing on the chart might look simple, but remember, simple techniques are the ones that work very well. Simple techniques are working very well. And all I'm doing is I'm engaging the help of the moving averages, 20 EMA and the 50 EMA, to help me visualize the trend. So here we are in an uptrend. Here we are in a downtrend, some short uptrend again. If the lines are close together, that's a ranging market, you don't trade. So ensure at every point in time